Welcome to video M18C on the contribution income statement. We're also going to do a little bit of overhead allocation, which we've done before. We're going to revisit it again. So we're going to do a couple mathematical computations in this video. So might make sense. Number one, go ahead and print off the slides for this one maybe, or have them handy on your screen. And then number two, get your calculator handy so that you can follow through with some of these calculations. All right, here we go. So a common form of profit center evaluation is the contribution income statement, which is based on the contribution margin developed for each profit center and for each relevant group of profit centers. So contribution by profit center, or CPC, measures all costs traceable to and therefore controllable by the individual profit center, including traceable fixed costs. Subtracting the controllable fixed costs from the contribution margin results in the center's controllable margin. The contribution margin income statement can also be used to help determine whether a profit center should be dropped or retained. One complication in the preparation of this statement is that some costs are not traceable at a detailed level, but are traceable at a higher level. For example, the non-traceable Division B costs are traceable to both profit centers. Positive values for CPC mean that the profit center, be it a division or product line, is covering all of its traceable costs, both variable and fixed. Since a portion of the fixed costs are not controllable but are traceable, CPC is a useful measure of the economic performance of a profit center, and it's a useful measure of the long-term performance of the manager. To evaluate the short-term controllable performance of the manager, controllable margin is preferred, since that excludes non-controllable fixed costs. To assess whether a profit center should be retained or deleted, the value of the contribution margin, if positive, shows the short-term loss of dropping the unit. The controllable margin, if positive, shows the longer term, or approximately a year, effect on total firm profits of dropping the unit. The CPC of the unit, because it includes non-controllable fixed costs, represents the long-term, at least up to several years, profitability of the unit. For example, dropping product 3 would save $70,000 in the long term, but only if the fixed costs could be reduced. So fixed costs, as we just discussed, can be either controllable or non-controllable from the perspective of each profit center. So controllable fixed costs are fixed costs that the profit center manager can influence in some amount of approximately short time, like a year or less. Something like advertising or data processing or management consulting expenses. Whereas non-controllable fixed costs are, of course, those that are not controllable within a year's time. Things such as depreciation and taxes. The use of the contribution income statement is often called variable costing because it separates variable and fixed costs, just like we learned in the CVP chapter. Full costing is the conventional costing system that includes fixed manufacturing cost as part of product cost. Full costing is also called absorption costing, and that's required for GAAP, and it's also required for the IRS for computing taxable income. Full costing satisfies the matching principle, while variable costing meets the three objectives of a management control system. So in an example, SD Equity manages 4 apartment buildings, and management noticed that the more expensive rentals tend to occupy more of management and employees' time. So SD Equity charges a flat management fee of $500,000 for all of the 4 different buildings. And here's some of the detail of each of the buildings. And you can see that going from the top to the bottom, Cape Cod to Tudor Manor, they're ranked in order of the number of units. We've got the average occupancy for each building, and we also have the average rent. So you can see that they're also ranked from highest rent to lowest rent. And the question is, how should SD Equity allocate the management fee? So More expensive would align the costs, but that doesn't consider the number of units. So what we need to do is maybe use rental revenue, because that picks up not only the more expensive, which, as we know, management says we spend more time with those, but also equates to the number of units or the number of apartments being rented for both. So we can set up a schedule that calculates the rental revenue. So obviously that's going to be the number of units times the average occupancy times the average monthly rent times 12. And we can do that for each of these buildings and determine what is the percent of revenue that's being generated by each of the buildings. And we can use that pro rata share. We can determine the proportion of rental revenue over the total for each building and use that proportion to allocate the fee in what seems like a pretty fair way. Okay, so in our second example, we're going to prepare a contribution income statement. So Creature Drinks manufactures energy drinks that sell for $4 a can. And they're going to produce 52,000 of them this year, and they're going to sell 50,000 of those. The direct materials per drink is 55 cents, the direct labor is 25 cents, and the variable overhead per drink is 15 cents. Total fixed overhead is 39,000, and fixed SG&A costs are 50,000. So first we'll look at this under the full costing. And remember, we use full costing for things like our financial statements and for tax purposes. So we take the number sold, that was 50,000 sold times the $4 per can, or $200,000 worth of revenue. Then we can add up the variable cost per unit. That's the 55 cents of materials, 25 cents of labor, 15 cents of variable overhead. But we also need to consider the fixed overhead, because remember, that becomes part of the product cost under full absorption. So that leaves us with a total cost per unit of $1.70. So 50,000 units times $1.70 is 85,000. The gross margin, therefore, is 115,000, and our operating income is the 115,000 less those fixed SG&A costs of 50,000, or $65,000. Okay, let's do the same thing under the contribution system or variable costing. So revenue's the same, 50,000 units times $4. But in this case, remember, we are dividing between fixed cost per unit and variable cost per unit. So we don't worry about any fixed costs to get to contribution margin. So we add up the same variable costs, except we exclude the fixed costs, so it's only 95 cents. So that means our total variable cost is 50,000 times 95 cents, or 47.5. That gives us a contribution margin of 152.5. From that, we deduct the full fixed costs as period costs. That gives us 63,500 of operating income. And you can see that we have a difference between operating income under full costing and operating income under variable costing. And that's a function of those 2,000 units of inventory. So recall, we produced 52,000. We only sold 2,000. But the difference is we're going to bury that fixed cost inside the inventory under full costing. So under full costing, the amount that's still in inventory is the $1.70, which was the total cost, minus 95, which was only variable cost, times the 2,000 units, that's $1,500. That explains the difference between operating income under full costing and operating income under variable costing. All right, that's the end of Chapter 18 and video M18C. We're going to scoot off now and do Chapter 20. Thanks for watching.